Today we're diving into a strategy that people keep asking me about. Can you really double your weekly dividend income? I tested it step by step to see if it actually works. We're talking real ETFs, real strategies, and a method that could make your money work harder every single week. If you've ever wondered how investors capture consistent cash flow without constantly adding more money, this video is for you. Stick around, because by the end, you'll know exactly how to set it up, the risks to watch for, and whether this approach could fit into your portfolio. All right, let's start by looking at my current setup and what we're aiming for. This time, I got $10,000 invested in a weekly dividend ETF. Let's use ULTY as an example. That's a real ETF that pays weekly dividends, and it's a good one for income-focused investors. With $10,000 in ULTY, you're currently earning roughly $160 every single week. That's your starting point. It's steady, it's reliable, and it gives you a predictable stream of cash without having to sell anything. But here's the exciting part. What if we could double that weekly income? That means going from $160 a week to $320 a week without adding another $10,000 to your portfolio. Now, doubling your weekly dividends might sound like a big leap, but it's not about taking crazy risks. It's about using smart strategies with the ETFs you already own, understanding when to reinvest, and taking advantage of the way dividends and option strategies work. By the end of this video, you'll see exactly how to make this happen, step by step, so you can get closer to your goal of building a bigger, more consistent income stream every week. Now, let's break down the dividend capture strategy and why it's so useful for weekly dividend ETFs. The concept is pretty straightforward, but understanding the mechanics can really make a difference in how much you earn. Here's how it works. You buy a stock or ETFs just before the ex-dividend date. That's the date you need to be on record to receive the dividend. Then, you hold it through that date, and you collect the dividend once it's paid. After that, you can sell and move your money to the next stock or ETF with an upcoming ex-dividend date. But here's an important insight. Not all dividends are created equal. Some ETFs adjust their price slightly after the dividend is paid, and transaction costs or taxes can eat into your gains. That's why weekly dividend ETFs like ULTY are ideal. They have multiple X dates in a month, giving you frequent opportunities to capture dividends without needing a huge portfolio. In essence, this strategy allows you to cycle your capital efficiently, generating income over and over from the same initial investment. It's like making your money work in a loop. You just buy, hold, collect, sell, and repeat. This way, you're maximizing your weekly cash flow in a smart, systematic way. Now, let's get into how a weekly dividend plan actually works in practice. The idea is to keep your money moving efficiently so you can capture multiple dividends within the same week. Here's a simple example. Let's say you start with ETF A. You buy it before its ex-dividend date. Let's say that's Friday. You're going to hold it through the date, then sell it on Tuesday after collecting the dividend. Next, you move your money into ETF B, buying it before its Wednesday ex-dividend date and selling it on Friday. By repeating this pattern, you can capture dividends multiple times in a single week. This is where weekly or frequent paying ETFs really shine. Real funds like Robinhood MSTW, which target MicroStrategy and crypto exposure, or YMAX ETFs, which focus on high monthly or weekly income, and that's what makes this possible. For instance, Robinhood MSTW currently trades around $32 per share and pays weekly, while YMAX ETFs offer yields in the double digits, depending on market conditions. By rotating through these kinds of ETFs, you're essentially letting your capital work continuously, rather than sitting idle waiting for a single payout. The key takeaway here is that a planned weekly rotation lets you consistently generate income from the same pool of money, leveraging multiple X dates in a month to maximize cash flow. It's all about timing, planning, and using the right ETFs to make it work efficiently. If you're enjoying these simple breakdowns and want more videos like this, make sure to hit that subscribe button and turn on notifications. Also, drop any questions you have in the comments. I personally read every single one and reply. So, whether it's about weekly dividends or building a retirement portfolio, I've got you covered. Let's make this a place where we can all learn and grow together. All right, let's break down what actually happened week by week, because this is where things got really interesting. Week 1 was our warm-up. We started with $10,000, ran the strategy as planned, buy before the ex-dividend date, collect the payout, sell the position, and rotate into the next ETF. When the week wrapped up, we had earned about $222 in dividends. Now remember, our target to fully double our weekly income was $320, so we only hit about 68% of the goal. Not quite there yet, but we actually ended the week slightly ahead in portfolio value, sitting at about $10,150. So the account was growing, income was rolling in, and at this point, things felt pretty safe. Then came week 2, and this is where it started to get exciting. We ran the same strategy, same rules, nothing fancy, and this time the dividends jumped to $389 for the week. That's 121% of our goal. So yes, we went beyond our goals and our weekly income for the first time. But there was a trade-off. Some of the ETFs we sold had weaker prices when we exited, so our portfolio slipped to about $9,950. Small dip, but the income boost more than made up for it at this point. Week 3, though, was a roller coaster. We hit our biggest payout so far, $698 in 1 week, which is over 200% of our original goal. On paper, it looked amazing, but the ETFs we rotated into dropped hard after the dividends were paid. Our account value sank to around $9,350. It was that feeling of getting a big paycheck, but realizing the foundation underneath you is cracking. And then week 4 wrapped things up. We brought in another $480, so still well above 150% of the goal. But the portfolio value kept falling, ending the month at roughly $9,200. So looking at results across 4 weeks, yes, we doubled the income multiple times, but we're finishing with a smaller account than we started with. Next, let's compare this to a simple buy and hold strategy to see if all this effort actually paid off. All right, we took our original $10,000, just bought the ETFs, held them all month, and collected every dividend without lifting a finger. At the end of 4 weeks, we had earned about $628 in dividends. Not bad, right? But here's the catch. While we were earning those payouts, the ETF prices were sliding, and our portfolio value dropped to around $9,474. So, when you add up dividends plus the remaining portfolio value, we ended up with about $10,102 total. Now, on the right side, we have the buy and sell dividend capture strategy, the active version. Same starting point, $10,000. But here, we kept rotating, capturing multiple dividends each week. At the end of the month, we had pulled in about $1,556 in dividends, way more than the $628 from the set and forget approach. But just like before, ETF prices kept slipping, so the portfolio itself was worth about $9,982 by the end. When you add everything up, that's $11,538 total value. This is clearly higher than the $10,102 from the passive strategy. So, what's the bottom line? The buy and sell method gave us more than double the income in the same time frame, but it came with way more effort and some wild portfolio swings along the way. The set and forget approach was simple, hands-off, and steady, but the income was much smaller. So really it comes down to your style as an investor. Do you want to maximize income and accept the price volatility, or would you rather keep it simple and settle for lower payouts? There's no right or wrong answer here. It's all about your goals and your risk tolerance. So here's the bottom line. Yes, it's possible to double your weekly dividends using strategies like dividend capture with weekly ETFs. But it's not free money, and it's not completely hands-off. There are a few important things to keep in mind. First, this strategy requires more active management. You're buying and selling around ex-dividend dates, which means you need to track schedules, monitor prices, and make moves consistently. If you're not organized, it's easy to miss opportunities, or even make mistakes that cut into your profits. Second, you'll likely experience bigger portfolio swings. Because you're moving in and out of ETFs more frequently, the value of your holdings can bounce up and down, more than a traditional buy and hold strategy. This doesn't mean you're losing money, but it does mean your account balance will fluctuate more, which can be stressful if you're not prepared for it. To balance growth and income, one approach is to combine growth-focused ETFs with income-focused ETFs. That way, your portfolio still has a core foundation of steady growth, while your income-focused portion is actively generating higher weekly payouts. This creates a balance between stability and cash flow. Finally, here's something to think about. Would you rather have a steady, predictable income or chase higher payouts even if your portfolio value bounces around a bit? Drop your answer in the comments. I'd love to see what approach you'd take.